After 25 years of trading, I've seen it all. The highs, the devastating lows, and the brutal mistakes that can wipe out an entire portfolio. If you think trading is about quick wins or guessing market moves, you're setting yourself up for failure. The truth is the market doesn't care about your predictions or emotions. But with a few key strategies and the right mindset, you can give yourself a real edge. Stick around, because today I'm going to show you the most common mistakes that even experienced traders make, and how you can avoid them. Mistake number 1, trying to anticipate news events. This is a huge mistake, especially for retail traders. You might think you're clever by trying to predict how a stock will move after a big news event. But here's the truth. The game is rigged against you. Most big hedge funds and basically all the banks are already trading based on that news before you've even read the headline. Thanks to artificial intelligence, these institutions can read news reports automatically, analyze key data points, and execute trades based on substantial statistical backtesting, within a second or two of the news announcement being released, without any human involvement. I'm not joking. By the time you've read the report, processed it, and placed your order, it's too late. The big money has already moved. And the risk-reward dynamic has shifted dramatically. Yes, you might catch the tail end of a big move, but you're playing a losing game. Not to mention, this approach requires you to be glued to your screen constantly, waiting for reports like non-farm payrolls or earnings releases, and even then, you'll still likely be too slow. Mistake number 2, not having a specific plan for each trade. One of the most common mistakes traders make is entering a trade without a specific plan. The difference between success and failure in the market often comes down to one thing: discipline. Successful traders are not just guessing, they have rules that guide them. Quantitative trading, where trades are based on back-tested rules, gives you an advantage because it's not subject to the whims of emotion. With a predefined system, you know when to enter and exit trades based on hard data. Even if you're more of a discretionary trader, the best in the game have rules too. You'll find that top discretionary traders actually act like systematic traders. They know their setups and rules by heart and write them down. They aren't just going with gut feelings. They're following a structured approach. So, before you place your next trade, ask yourself, do I have a clear plan for my entry and exit? Am I managing my risk properly? If you can't answer these questions, you're essentially gambling with your portfolio. Mistake number 3, not cutting losses. This is a classic mistake that can ruin a trading account faster than you think. Failing to cut losses early is one of the quickest ways to wipe out months of hard-earned gains. When a trade goes against you, it's easy to hope it'll bounce back, but that hope often leads to deeper losses. Here's where having a predefined exit strategy comes into play. Whether it's a stop-loss order or an exit based on technical indicators, the key is to take action before small losses become catastrophic. If you ever find yourself hoping a trade will recover, that's a major red flag. Picture this. You're holding onto a stock that drops 20%, and instead of selling you think it'll rebound, but then it falls another 20%. Now you're down 40% and it becomes much harder to recover from that kind of loss. Mistake number 4, not understanding leverage. Leverage can be both your best friend and your worst enemy. It allows you to control a large position with a small amount of capital, which sounds great until you realize the risks. Let's break this down. If you're using 2 times leverage and your broker, like Interactive Brokers, is charging a 6% margin rate, you're losing 6% of your portfolio annually just in interest. That's on the low end. Other brokers charge even higher rates, like 12% at Schwab. So if you're not making consistent profits, these interest costs will eat into your returns. And that's before we even talk about potential losses. I personally trade with leverage, but have spent more than 20 years refining my systems. If you're still learning, those interest costs can crush your portfolio. Let's say you're just starting out and only averaging a 10-15% annual return. Those leverage fees might wipe out your gains entirely. If you are getting some value from this video, please subscribe. It really helps us out. Thank you. Mistake number 5, not backtesting your strategy. If you're not backtesting your trading strategy, you're basically flying blind. A backtest allows you to see how your strategy would have performed based on historical data. It's not just a nice to have. It's essential if you want to avoid wasting time and money on strategies that don't work. For discretionary traders, this doesn't mean you have to code or build complex algorithms. Just write down your rules, and test them manually. Even that will give you a better sense of whether your approach holds water. You can also hire someone on platforms like Upwork to help you code a strategy. The Wealth Lab team can also test things for you, or I can. I've used Wealth Lab to backtest my systems for over 20 years, and it's been crucial to my success. Without backtesting, you're essentially gambling with your time and money. Don't waste years of your life trading a system that has no edge. Mistake number 6. Overconfidence after a profit. There's nothing like a hot streak in trading to make you feel invincible. Maybe you've just made a huge profit off the artificial intelligence stock rally or caught a major market move. It's tempting to double down, increase your leverage, and go all in. But here's the danger. Overconfidence can lead to bigger risks, and bigger risks lead to bigger losses. Markets are unpredictable, and overestimating your skill or thinking you can outsmart the market will eventually backfire. When things are going well, it's easy to think, this trend will continue forever. But that's exactly when you need to be most cautious. Stick to your rules, cut your position sizes when volatility increases, and don't over-leverage just because you've had a winning streak. Mistake number 7, using market orders too often. A market order is when you simply buy or sell at the current price, crossing the spread. While this might not seem like a big deal on highly liquid assets like SPY, it adds up quickly with less liquid stocks. For example, let's say you're trading a small cap stocks with a 0.5% spread, and you turn your portfolio over 20 times a year. You're essentially losing 10% of your portfolio annually just from paying the spread. Over 5 years, you could lose up to 65% of your account through compounding losses caused by market orders. To avoid this, use limit orders whenever possible. This allows you to control the price you pay or receive and avoid unnecessary losses from crossing the spread. Now, if you take away just 2 things from this video, remember, don't trade too often, particularly with market orders, and always backtest your strategy. These 2 practices alone can set you up for long-term success in trading. If you found value in this video, don't forget to subscribe and check out my Patreon channel, where I provide in-depth coaching on these topics and can also test systems. Also, check out this other video top left for more trading tips and strategies.